Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, Michael Becker.
Hey, Paul.
And James Zhang. Hey, James.
Good morning, Paul.
In the podcast today, we have a special guest. I always talk about Mike being the smartest guy in the room.
Not today, right?
Not today. He has been displaced by Greg Willett. And we talk about demographics, about what's going on in apartments, but Greg has the mind that kind of helps us know what's going on with apartments all throughout the United States. And so Greg is the chief economist for RealPage. So he is definitely the smartest guy in the room. So everybody listens to him about what's going on with trends on apartments. Talk a little bit about what's going on with rental growth and what areas that you should be investing in and what areas should we have some concerns with. So in the podcast today, it's Greg Willett. Greg, how are you?
Great to be here with you. Certainly the pressure now is on for me to say something informative.
So if anybody doesn't know who RealPage is, let me just give you a quick briefing because I think they do a great job. So they are a property management software. They're really a technology company. Would you say that, Greg? Is it a technology company?
It's fair to say technology and then also data analytics, certainly that information that you can pull out of technologies.
And he has an undergraduate degree from Western Kentucky University. That's in Bowling Green, right?
It is. Go Hilltoppers.
And then he has a master's from SMU, and that's the Harvard of the South.
I guess go Ponies as well.
So we're going to talk a little bit about what he sees in the future. So I'm going to kick it over to Mike, and let's get it going.
Yeah, maybe you just kind of give us a little quick background on yourself and tell us a little bit about RealPage and MPF research as well, because I don't know if everyone knows exactly what you guys do, or you do so many things. I don't know if you know what you do, but give us a little overview.
We do a lot here at RealPage. Just in general background, I started my career in real estate at MPF Research, which was a boutique research shop that really focused on feasibility analysis for new apartment development. So I did that for a long time. We were acquired by RealPage around 2000, so we've been part of the RealPage family for quite a while. And I work in really all the analytics areas that RealPage touches, pulling information out of these technology systems. And I help the technology guys understand real estate and how you make money in real estate and what's important to the real estate people for the technology to actually provide.
Maybe give us a little sample too. So you guys do that, but what are some of the product lines that people on the street might kind of know?
The technology includes basic property management systems. That's our one-site product family. We also do resident background screening, a lot of automated payments. We have a renter's insurance company, which is a big division of ours. We do revenue management, which is the statistical modeling that helps you set rents on a day-to-day basis. In total, there are around 70 different products.
Yeah. So one of the things that Paul and I like to talk about is revenue management, and kind of that's the wave of the future. And most of the higher institutional grade properties are on it, and a lot of the B product properties are going to it, and the C's are kind of lagging there behind. But I think it's the wave of the future. Maybe you could talk a little bit about what is revenue management.
Well, revenue management has been around forever, Mike. I mean, look at how airplanes are priced. Take a look how hotels are priced. Now apartments are priced kind of similar to that.
It is statistical modeling that produces a recommended price for every unit every day. It's looking at forward-looking supply-demand trends and vacancy vulnerability and really taking the emotion out of pricing decisions. That's a challenge for a lot of companies. It needs to be approached from an analytical standpoint and really making the right decision on what's right in that marketplace on every given day.
That's great. Maybe we can kind of transition a little bit over and kind of just the state of the market. Generally, we're based here in Dallas, but we have listeners, I think, in over 50 countries, something like that. and it's certainly all over the United States. So maybe kind of talk about the apartment market nationally and kind of what's the general sentiment across the nation.
Yeah, I'll back up too. We've been on an incredible run. We think of this market cycle as having started in 2010 as we were coming out of the Great Recession, and really strong demand and some really great pricing power now for quite a few years. And that's fueled by what's happening in demographics. It's also financial. A lot of things have come together to make this really the strongest apartment market that any of us are going to see in our lifetime. It's not something that you can sustain indefinitely, but it's a great performance, really good momentum now, although, maybe we've probably the peak in terms of annual growth on revenues probably came last year, but still some very solid momentum.
That's great. So I always like to call it the golden age of apartment ownership. It really seems like it has been, and it can't be better than it's been.
I certainly agree with that. And it's not a realistic expectation for any of the metrics to think it's going to get better. It's the question of to what degree can you sustain what we've been doing over the past few years.
So maybe talk about rent growth nationally. So where we sit here, middle of March 2017 as we record this. So kind of what was 2016 like, and how did that compare to previous years? And then what are we looking like for 2017?
On a national basis, our effective rent growth for new resident leases was 3.7%. That's a good number. It's well above the long-term historical norm. Did come down a little bit from where we were the year before, where we were a little north of the 5% mark. But, I think most owners and operators are not going to be complaining about a rent growth number that's 3.5% to 4%.
So rent growth is good. What's the bad? What's kind of the clouds on the horizon, if there are such on the horizon?
Certainly, you don't sneak a healthy market past developers. They're certainly very aware of that, and they start building pretty quickly. So we are at a really high level of construction over the last couple of years, and then in 2017, the deliveries will kick up even higher. Nationally, we're scheduled to deliver north of 360,000 units this year. That's a lot.
Yeah, definitely. Is there any particular markets that you like kind of outside of Texas? We do a lot of conversations about Texas on our podcast, but anything outside of Texas, anything that you like or you don't like?
Certainly, as you're looking at overall performances right now, some of those markets that were sort of late economic recovery markets where you haven't yet gotten construction that's kicked in a big way, those are doing really well. Some examples there would be Sacramento is right at the top of the charts quarter after quarter after quarter. The Inland Empire, Riverside, San Bernardino area, Las Vegas is up there. And then you have really fast-growing economies, even though they've been going strong for a while, that are still doing incredibly well. Seattle's at the top of the list there. Some of the Texas markets, including North Texas, would be on that list. So it's really the kind of that mix.
Just to step back for a second on when you're talking about rent growth and occupancy numbers, how's the data coming into you guys? Because I think what's unique about your analysis is that you have more data than anybody else. And so maybe talk just briefly about that before we jump into Texas.
And certainly a lot of our data is market survey data, and you see that from other sources as well. And we've got a good base of history there. But let's circle back to these technology products where you can actually mine the real-time lease transaction info out of there. And so that does separate RealPage from some of the other data sources there, that you're seeing truly how much was this individual lease executed for, and also you understand who actually leased that unit. You know some background information on that household, and that helps with demographic profiles, et cetera.
So RealPage is almost like the Facebook or the Google of management company software out there.
We're certainly a big player in the technology space, and we are the company that has gotten big enough to actually become a publicly traded company specializing in that vertical.
So you have, I just looked on the website, you probably have 12,000 customers. And
we're right around that 12,000 mark, right.
You probably monitor 30 million leases.
We're seeing a lot of
30
what's
million.
going on.
So all that. So we're lucky we live in Dallas, Mike, because Greg's physically based here, but you guys have, 2,000-3,000 people in this office right here?
In our new corporate office in Richardson, we're between 1,500 and 2,000 people. We have operations worldwide. Total employment is right around the 4,500 people.
So I think James is going with is that you guys get all this information off these 30 million leases that are out there and put it into a black box, and you're able to data mine all that information that's coming in, and you cut it and slice and dice it so you have the cutting edge information up to the minute about what's going on with leases and rent growth and what are good markets, what are failing markets. So he's the man you want to listen to.
There we go. We have a lot of data. I'm going to object to the term black box because one thing that we're certainly, the message that we want you to hear is we are about transparency, that you can really see what's going on and the nature of the data that's going in there and the size of the database that any particular metric is pulled from. But yeah, I mean, lots of data being compiled into one giant stack of information.
But not a black box.
But not a black box. we would say a clear box.
Clear box.
But not a black box.
I got it.
No, that's great. So going from sort of the national scale down to Texas, maybe give a brief overview on just sort of the 4 major markets and what you're seeing in those right now.
And it's interesting as you look at Texas, a lot of times we talk about Texas as if it's one thing. And a lot of times the markets do behave in the same sort of pattern. But right now we're in very different situations in the major markets across the country and the major markets in Texas. And clearly, Dallas-Fort Worth, DFW, North Texas is a step ahead of the other markets, has occupancy at really record levels and rent growth that is pushing the 6% mark on an all-time high. Fantastic numbers for Texas, and the most active in terms of construction, about 50,000 units underway right now. Houston, obviously, given the energy sector, had to some degree has taken a beating. You've seen occupancy back off a little bit, and we're actually seeing overall some rent cuts in Houston at this point.
Is that across asset class or grade?
Certainly the rent cuts are heavy in that top tier product because we're still delivering these properties that got started when the economy was blowing and going. We're at the last stages of delivering that wave of new construction, but it's a very competitive market at the top end of the product spectrum, and particularly urban core top end. As you get out into the suburbs, it gets a little bit healthier. And then when you get into Class B and Class C product, actually to some degree, if you're in the right spot in Houston in Class B and Class C, you're actually doing really well. So a little bit more of a mixed environment in that one.
What about Austin? Maybe transition to Austin. What do you see in Austin?
Austin is kind of middle performance at this point. It looks a lot like the nation as a whole. And again, we like those national numbers. They're just not quite where we are at DFW. We've seen a little bit of a slowdown in the Austin economy. We're delivering a lot of product. And so it's healthy occupancy, but we are seeing rent growth more around the 3% mark compared to 6% in North Texas. So solid, but not through the roof.
And how does that cut across the property grades?
It's interesting that in Austin, the performance is more steady from one product niche to another, and even from one neighborhood to another than it is in the other Texas markets.
Yeah. So is that more a function of developers not going to Austin as much, or is just getting too expensive, or is it more jobs that the jobs are still in Austin compared to Houston?
Developers love Austin. There's been a lot of product that's been built. There's still a lot that's on the way. It's really just we've taken the local economy, which had been expanding at about 4% annually, and now it's doing about 2% annually. Again, 2% is not a bad number. It's pretty similar to the national number. It's just Austin is not clicking on all cylinders right now the way that it has been over the past few years.
What about San Antonio? What is your take on San Antonio?
San Antonio is certainly traditionally the most stable of the Texas markets, and you almost never hit a home run in San Antonio, but it's also really hard to strike out and mess up. And so kind of that middle of the road performance, okay, but not spectacular occupancy, usually the same thing on the rent growth. You tend to run right around that 3% mark. almost all the time in San Antonio, and that's what we're seeing right now.
Is there any noticeable difference in the property grades and their performances in San Antonio?
A little bit, and kind of unusual on a national pattern. It's the top of the market product that's actually doing the best in San Antonio at this point.
Do they have less supply being built relative to the current base, or is it just kind of later in the cycle?
It's pretty aggressive building in that one as well. Again, it's Texas. We love to build.
Okay. Flat goes on forever,
yeah,
right?
So there we go. There's always going to be new supply coming online.
Right, cool. Okay, so then, a lot of the business we do here is based in DFW, so maybe we talk a little bit more in depth about some of the DFW, kind of touched high level. So we're seeing, upwards of 6% rent growth in 2016, if I remember correctly from your presentation.
Right, we're at 6% or so. Again, we're going to deliver a lot of product in the coming year. We think that will slow down the rent growth a little bit, and particularly a high-end product, urban core, it'll slow it down a little bit. So our expectation moving forward over the next couple of years is something more like 4 to 4.5% rent growth. But again, we shouldn't be complaining about 4 to 4.5%.
So I've heard you speak a bunch. So you always say that last year was good and this year's going to be worse. So it's kind of same song, second verse a little bit. But
I am an economist. That means you're always looking at the downside risk.
So maybe we get a little granular here. So let's talk about Class A. So we're delivering 50,000 units under construction. We're going to deliver somewhere around 25,000.
Yeah, well, this in 2017 we should finish up somewhere between 25 and 30,000 versus in 2016 the completion number was about 20,000. So we are kicking up the completion pace.
So James and I office in Frisco. So we see, I think in a 1 mile radius around our office building, somewhere near 4,000 units being constructed right now between the North Plano, Legacy West, and South Frisco location. So what are some of the pockets? Obviously that location, Uptown. Where else is the supply concentrated? Is it spread out? Kind of talk a little bit about how you see it being delivered and the effect on the market.
Well, certainly when you have 50,000 units under construction, that means pretty much every neighborhood you've got at least a little bit coming. But certainly the two key concentrations are the Uptown Dallas area, and include in that some fringe areas where we're starting to go into West Dallas, North Oak Cliff, and on the east side of Central Expressway as well. So that's certainly the biggest pocket of activity. And I'll point out there's a lot of high-rise, really expensive product in that pocket.
What kind of pricing on the high-rise are we talking about versus kind of historic numbers?
Yeah, the average price for a new unit coming online in that urban core area, it tends to be $1,800 to $2,000 versus when you get out into these upscale suburbs, a new unit price tends to be $1,200 to $1,300.
What is that on a foot basis?
So it's probably $175.
Yeah. Certainly urban core.
Urban core is
urban core. Yeah,
yeah.
you're getting around to $250.
Yeah. Is there any other pockets, too, that are seeing a lot of supply?
Certainly, as you look at these northern suburbs, as a whole, they're really active. But if you look at any individual one, there's a question there. Certainly in Frisco, very aggressive. There's enough coming online that it is maybe the one spot in the suburbs where we're getting enough new supply that we've brought down the rent growth in the Class A segment.
Got it.
The risk that a lot of our investors have if they're buying B and C is if A gets overbuilt and they start sliding into our B product. But do you see there's a big enough gap between the A and B that's not going to impact the rent growth on the B stuff?
There's a pretty big gap between A and B, and that's something that we actually talk to our clients about a lot. If they have that B space, and particularly if they're using the revenue management software in the B space, keep in mind that if you soften the A, make a more competitive environment in the A space, that doesn't necessarily mean you need to tap the brakes in B.
Like what kind of, we're talking 20, 30% nominal rent difference in overall?
It's interesting on a national basis right now, the premium of A over B is close to 40%.
40%, wow.
Yeah.
Wow. So a lot of the people we do business with, we primarily focus on C and B multifamily lending. So that's the predominance of our client base and listener base, I believe. So, what I do for a living as well is, we buy, renovate B product in kind of the northern suburbs of DFW and the kind of the better suburban market. And then we do a lot of C stuff as well from the lending perspective as well. Maybe kind of talk about what we see for rent growth in both the B and the C in the suburban DFW market, as well as is it still a good opportunity to go find, if you can find it, go find underutilized properties, go in, implement a renovation strategy, and raise rents? Is that still a viable business model in your opinion?
Certainly the rent growth leaders in most markets across the country, and that does include North Texas. I mean, it is that B and C product. And over the past year or so, we've seen rent growth that gets to 6 to 7% in that B space.
That's just organic rent growth on classic units. This is not necessarily, is that blend with the renovation
It blends in some upgrades that are happening there, but we don't think the upgrades drastically are skewing.
So the bulk of that is just organic rent growth.
It's just organic rent growth. And again, I wouldn't necessarily expect the rent growth to hold at that level over the next couple of years. But again, you can back off from 5 to 6% and still get some really good numbers there. And we do think that is the key strength moving forward.
So I moved to Texas from California in 1992, and I've had a couple of my friends move to Texas. We have 50,000 units that are being built right now. How many people are moving to Texas, and what's the future look like on that?
I mean, it's an incredible immigration story of newcomers coming in from across the country and really from across the globe. And you sort of shudder in terms of how do we deal with 50,000 units coming online? I'll point out that in this economic cycle, which for us, as we're measuring it, goes back to the beginning of 2010, in Dallas-Fort Worth, we have created 680,000 jobs. I mean, right, pushing up to 750,000 there. I mean, that's essentially, we've added a whole nother metro to Dallas-Fort Worth just during this economic cycle.
Thank you, California.
So when you look at that many jobs coming in, there's typically a metric, for every new job, how many apartments we should have come online. Do you guys look at that and figure out sort of, are we undersupplied or is the absorption still there? How do you guys look at absorption?
We certainly think of job production and then in turn household formation is the underlying support for apartment demand. We hate this formula that says 5 to 6 jobs equals demand for one unit, because that at any given point in time in any given metro, that is false basically 100% of the time. So it's maybe a rule of thumb to think about over the course of an entire economic cycle, but it's never true at any given point in time. And also, in a lot of places across the country, how many units you can absorb depends on how many are available. And keep in mind, the rest of the world does not build nonstop the way we do in the Texas markets. And so certainly product availability shapes that rate relationship in lots of places.
Do you think in North Texas we're reasonably balanced in your overall estimation from supply to future demand and what we're delivering?
Well, again, if we're at occupancy of 96% or so, vacancy around 4%, that's an all-time high. Clearly, we're not overbuilt at this point.
I mean, a lot of our investors ask from 2010 or maybe 2012, just the last 4 or 5 years in the Class C space, how much rents have come up, and do those renters, are they making enough in terms of wages and income growth to support this continual 4 to 5%, 6% on the C stuff?
The affordability question, I mean, and that's a great one, and it is something that I think everybody has to think about. What tends to happen is that as you go through this cycle and the rents get higher and higher, you upgrade who you're renting to. And we can actually look at, again, these individual lease transactions, and I can see how much this household is paying in rent, and I can also see how much income this household has. And that rent to income ratio actually hasn't moved in this cycle. So yes, the rents have gone up, but we've upgraded who we're renting to enough that we've not changed that formula. Now, that does beg the question, what happens to the people who just don't have the incomes to afford market rate apartments? And they do just drop off the radar. And so obviously they're in subsidized housing. They can be in really low-priced single-family rentals that are not in great shape, but they do kind of just drop off the radar screen for the apartment sector.
I think one of the things I took when you spoke at the Old Capital Speaker Series, which we have another one coming up on April 26th, when you spoke at that about a week or two ago, you mentioned how the southern sector of Dallas and kind of the historically lower socioeconomic areas have really seen rent growth and absorption of those units. So they just basically just going south of the river. They're going from South Irving to South Dallas. Is that essentially what's happening?
You do have pockets in Dallas-Fort Worth that traditionally have had pretty high vacancy. I mean, they're just not the most desirable areas. The product is not of the best quality, and they've tended to have some chronic vacancy issues. Man, they're full at this point. And at the same time, rent growth is really strong in those. So I think to some degree that does speak to, on an individual lease, we're not changing that affordability calculation, but we're clearly pushing some folks into areas they maybe would not have gone to historically.
Is that a risk you see potentially in the market for that little subset if you're kind of in the historically higher crime areas? We hit a little soft patch of the economy.
Again, I'm going to circle back to, I'm an economist. I'm looking for downside risk. I would be nervous that, if something goes wrong, that's where it goes wrong first.
Got it. Okay.
So who are really the tenants of these properties these days? In the Class A, Class B, and Class C, you guys in your clear box, and I have the little, I say that very lightly, but in your clear box, who is renters? I mean, what do they do for a living? What do they?
Is that different than it was 10 years ago?
It's a great question. And just to circle back to, it really is different than what it was historically. And I'll back up to the first part of my career where I was doing feasibility analysis for new development. And there was a little bit of nuance from one location to another, but you basically knew who you were designing this product for. Now renters are incredibly diverse and really a broad income spectrum, a broad age spectrum as well. A lot of times in our industry, we talk about them in terms of age only, but sometimes age is not what moves the needle there. There can be other characteristics as well. So we've run 4 million leases through clustering software and said, put like households into individual buckets and describe renters to us. And we came up with 8 different categories. And a lot of times you're going to be renting to more than one category in any given property. So again, it's playing the segments at this point. There's not a one renter profile. And I hate whenever I talk to folks in the industry or even here internally, particularly when I'm dealing with the tech guys, and they say renters do something. That's never true. That's some renters do this.
Walking through your facility here, which is again 400,000 square feet with a lot of tech people walking around, a lot of the millennials. I would imagine a lot of these people are going to be renters. Is that the growing segment, or is it the seniors that are looking to lease and lock and leave type of stuff and sell the big house and move into an apartment building?
It's both, and it's the people in between. I mean, they're all fueling that renter audience, but I mean, if you look at the raw numbers, we've still got another decade or so of growth from where the millennials really are the driving force. We are starting to talk about the downsizing baby boomers more and more in the industry, and that's real, but it's not really all that widespread. But there are so many of the baby boomers that you just take a small percentage of them doing any one thing, and that adds that's a big block of people. But again, the primary audience is still going to be young adults, but it's not exclusively young adults. And I'll circle back to, when I was in designing product and feasibility study days, I mean, we were really thinking about that group exclusively. You have to think about the other groups as well now.
Kind of circling back to DFW here, is there any particular submarkets that you like better than the others that kind of stand out as potential opportunities that might kind of disproportionately benefit from the future growth compared to some other submarkets in our market?
Certainly we love the high-end suburban story here in Dallas for top-end product. At the same time, these middle market to bottom-end properties are doing so well across every neighborhood, including the blue-collar neighborhoods. And a lot of times I'll point out when we talk about Dallas-Fort Worth, we tend to only think about Dallas. man, the Fort Worth numbers are fantastic. Really, pretty much through every neighborhood in Tarrant County looks really attractive.
That's good. So Tarrant County's disproportionately growing at a faster rate than the Dallas side?
I mean, it's really a fact. Again, we've got 50,000 units under construction in Dallas. In DFW, 42,000 of those are on the Dallas side. So obviously that means we're just not overwhelming Tarrant County with new supply the way we are on the Dallas side.
A lot of good information, good data. But talk about things that concern us in the B and C market is demographics of immigration status of people coming across from Mexico. What's your 2 cents if this wall goes up, and what's that going to do to apartments, whether it's in Texas or Arizona or California? What happens?
Restrictions on growth are a downside risk, and that includes restrictions on people actually coming in, but it's also restrictions on the economy. I'll point out that, I mean, if we go to a restrictive trade environment where you're really trying, particularly if you're going to tax imports, Texas disproportionately takes a hit. Texas and California are big trade states. So you're talking about benefiting the upper Midwest and the traditional Rust Belt over growth that naturally would go to places like Texas and California. So again, it's a downside risk. You have to be aware of that whenever you're making any decisions, and it's also part of the general perspective that you need to have that, you know, it can't be the best apartment market performance ever forever. You do have to think that it's probably going to slow down, which doesn't mean it's going to be bad, but it is going to slow down from where we have been.
Give me other areas of the country that you like. You know, is it Miami? Is it New York, New Jersey? Is it the state of Washington? You know, what are you guys forecasting for great apartment markets?
Certainly worth thinking that the overall performance for the country as a whole is pretty solid. You always have some variation from one area to another. I don't know that we're expecting drastic shifts in the general patterns that we're seeing right now, although there's some risk in some of these tech-focused markets. We talked about a slowdown in Austin going from 4% economic growth to about 2% economic growth, and that really does reflect a tech sort of slowdown. You see that in the Bay Area and some other places. And then the other thing that we're a little bit wary of as we move ahead is just operational behavior. And there are some places when you start to deliver more product that there is a tendency on the operations side to panic. And right now we're actually, for example, cutting rents in New York and in parts of the Bay Area just because we're delivering supply more rapidly than we tend to, but at the same time, it's being leased up really quickly. You don't have any real vacancy issues. So we think that operators are not making necessarily the best decisions in some of these markets. So you have to watch for that.
Trust your revenue management.
We circle back to make fact-based decisions rather than emotional decisions.
So Mike, you use operational efficiency with management software for Yield Star or so. What do you think about that?
Yeah, it's been great. There's no way that any one person can do all that analytics and know everything that's going on in the market. So it's not always 100%, but it's 99. I would say, and we try to follow it at all cases, unless we're just really trying to go in and we implement a specific upgrade program. We don't think the revenue management is fully capturing it, and sometimes we'll push harder than what it suggests, but I don't think we ever try to dip below what it suggests.
We're going to work with you on best practices there because we think you can actually use that during a renovation as well.
Well, we should talk about that off mic then.
And how about amenities? You look at a lot of properties. What are some of the newest amenities that some of these Class A properties have these days?
It's interesting that I'm actually moderating a session on this at the upcoming National Multifamily Housing Council research forum that's going to be here in Dallas. I've got some developers lined up to talk about this. And kind of my question I've got for them is, what's cool and helps you get the leases versus when the people move in, what do they actually use? So I don't know that I'm the best source on that information versus what a developer would tell you there. But at this point, what I would really kind of circle back to that we're talking to our clients about over and over and over again as we're delivering more product and the leasing environment is getting a little bit more competitive, it's about service and that relationship that you're creating with the residents. And as the market gets more competitive, you need to make sure you're doing a really good job on the basic block and tackle sort of stuff.
That's great. So if anyone wants to find a little bit more about your company or you, what maybe some resources you can give out to everyone to find out a little bit more about RealPage and Greg Willett?
So certainly you can come to our website, which is realpage.com. We have a lot of brand names because we have a lot of different products. If you're looking on the analytics side, there's mpfresearch.com. We just recently purchased another big source of analytics, which is called Axiometrics. We have not merged those websites together yet, so Axiometrics is still out there as a solo sort of place for analysis, and we'll be bringing those data sets together as we go through the course of 2017. So we're actually looking forward to, we have a lot of data now. We're going to have a lot more.
Yeah, that's great. And then one of the things Greg I alluded to earlier spoke at the Old Capital Speaker Series a couple of weeks ago, and he did a slide deck for that. So if anyone wants to kind of know why DFW is the center of the multifamily universe, as I like to say, and why we're different, we have a whole bunch of slides about that from Greg's presentation then. You can certainly email info@oldcapitallending.com, info@oldcapitallending.com, or go to the oldcapitalpodcast.com page. And then maybe one more thing you could do is go to Facebook and like and follow Old Capital Podcast on there as well. We try to put out a video that Greg did a few weeks ago about the Dallas multifamily market. So you guys put out these little 4 or 5 minute videos on the different metros across the country. I find them very informative. So certainly look that up on YouTube. I'm sure that's linked to your webpage as well too, Greg, right?
Yeah, absolutely.
Yeah, perfect.
And the next speaker series, again, is April 26th. It's a Wednesday at the Grapevine Convention Center. So if you have not RSVP'd to that, please RSVP to that.
Who's going to be speaking there?
And we have Mark Dotsauer from the Texas A&M Real Estate Center, the former economist from there. He's
great, gives you a great perspective of what's going on in just the general economy, not just Texas, but in the United States, about commercial lending and what's going on just on a high level. People really enjoy his commentary. You do want to attend that seminar if you can. Grapevine Convention Center. Let us know if you're coming, because that'll be a packed.
And I will say I've known Mark for a long time, and for an economist, he's incredibly entertaining. And I'll couch that too. Let's not have unrealistic expectations because he is an economist, but
pretty damn funny.
But pretty damn funny, yeah.
So, Greg Will, we do appreciate your help and letting us all understand a little bit about what's going on in the general market, not just Texas, but the nation. Sounds like, Mike, would you say we're thumbs up still?
Yeah. No, we got through this whole interview too without asking what inning we're in, so that's good. I think that's kudos to us.
I appreciate
tired
that.
Analogy
that is my least favorite question.
But yeah, it feels as an operator of apartment complexes that we are maybe a little soft over November through January, just being on the street. And I knew some of that seasonal, it seemed a little softer than last year, but once we hit February and now we're into March, I mean, it's raging out. I mean, I think the activity in leasing has just been strong, and at least our properties in the B product in suburban Dallas, it just seems like it's going to be another good year, no question.
Fantastic. James, thanks for hanging out with us in the podcast. Mike, thanks for hanging out with the podcast. And Greg Willett, of course, thanks for hanging out with the podcast. We appreciate it. Again, I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.